All right, good afternoon and thanks for tuning in. You're watching Tracking Trends with me, Nikunj Dalmia. So what are the trends? Well, the big trend is that markets are bouncing back. We found support at the lower levels. Has Nifty stabilized enough? But then why is the bank Nifty underperforming? We'll really understand that what is right and what is wrong for the banking sector. For a sector which was supposed to make a comeback, has the comeback been stalled, or best of the gains in the near term that is behind the banking sector? But before we do that, here are the market headlines and what I'll be tracking for you in terms of the market move point. Volatile move on Dalal Street, Nifty above 21,300. Broader market after yesterday's knee-jerk reaction, they are bouncing back. So after an ugly Tuesday, it's turning out to be a comeback Wednesday for Indian markets. And in terms of sectors, dollar is at a 6-week high. Metal stocks are a sectoral underperformer, and pharma stocks are gaining in trade. But what are we debating, discussing, and what would we be elaborating on? Well, very simple. Is the peak of earnings behind us? Have banks peaked out in terms of the earnings trajectory? What is causing a drop in NIMs for banks? And where are banks headed post Q3 numbers? Have the NIMs peaked out, and will the battle for deposits, which is the low-cost deposit, will that only intensify going forward? Now, why is there a slowdown in banks? Very simple, very, very simple. Banks are the business of taking deposit and lending. Now, deposits are slowing down, which is that Indians would save 30% earlier in fixed deposits, real estate. Guess that number of money which was getting mobilized into fixed deposits is slowing down. Why? Money is moving into stock market. Money is moving back into real estate. Money is again moving on the discretionary side, as the young millennials do not want to save that much. All that is having an impact on the deposit growth. Liquidity, Reserve Bank of India is still of the view that inflation or the war against inflation is not over, which means they'll continue to tighten the squeeze of liquidity, and which is really helping them to control inflation. But that also means the liquidity in the system is getting tighter. CASA ratio on a large base, now that most of the banks have recovered from their brand image damage, especially smaller PSU banks also, a lot of CASA is going back into smaller PSU banks and also fintech. And then because interest rates have peaked out, have the credit deposit, now that interest rates have peaked out, have the NIMs also started coming under pressure? Because when interest rates are rising, NIMs they tend to expand, but when interest rates they stall, NIMs they tend to peak out. But there's one graphic which I would like to point out here, and that is the deposit and the CASA ratio. So I'm just going to walk to my frame and talk about this lovely data. This is what the CASA and the deposit growth is. For HDFC Bank, the deposit growth is less than 2%. Kotak Mahindra Bank, 2%. And for its ICICI Bank, IndusInd Bank and Axis Bank, the numbers are not that bad. Of course, ratios and the bases are different. But in percentage terms, the clear problem is that the deposit for HDFC Bank and Kotak Mahindra Bank ain't coming. That is also because a lot of deposits are going back to other banks also. Similarly, NIMs for some of the banks have peaked out, which is HDFC Bank NIM at 3.5%, IndusInd Bank NIMs at 4%, IndusInd Bank NIMs at 4%, and Axis Bank NIMs are at 4%. So NIMs in a sense are actually now peaking out. So at this point in time, I'll just invite Kunal and we'll talk about the top 4 banks. That's of course the 3-year move in some of the banks and where they've gone. You can actually see Kotak and HDFC Bank in last 3 years now have given you no return. Kunal, 3 years ago they were the darlings. People love them. They own them. But now patience is running out. Every time we think that patience is running out, we think that, okay, no, you don't sell HDFC Bank. This is like selling gold. You don't sell Kotak Bank. It is like selling family gold and silver both. And every time we think that it's time to change, we think that okay, the worst is behind us. Is worst really behind HDFC Bank and Kotak Bank? Let's look at the 3-year chart. HDFC Bank and Kotak Bank. You can use your magic pencil and then draw it for us.
Well, frankly, I would believe not. I would believe that there is still worse to come for these stocks. What we've seen right now is just positioning, where these stocks have changed in terms of the data points. Nikunj, I have not seen the extent of shorting. So this is the 3-year returns for HDFC Bank. The stock has just been all over the place. No signs of trend emerging. But then there is something which has changed in the last 7-8 days in terms of the data points for HDFC Bank and Kotak Bank. I think that's the more intriguing one. You've seen a 79% jump in the open interest for HDFC Bank. On the FNO side, a massive delivery-based selling which is happening to the stock price. Now, look at this way, that traders who are looking to go short on a formidable high weightage banking name on the index as well as on the bank Nifty, and they are looking to create fresh shorts and exiting their delivery long positions. They are not looking for a trade of 3 days or 5 days.
This tired bull liquidation?
Tired bull liquidation.
Tired bull liquidation is a term which we use, and which means that the bulls of HDFC Bank and ICICI and Kotak Bank are getting tired. Arey, aur kitna wait kare? You know, when you see so much of other opportunities in the market and other banks are doing well, the best of the bulls, they would say, is it worth it? Because we are in the business of maybe banking with HDFC Bank, it gives you a great service, or Kotak Bank, but they are not giving you great returns. So this is called tired bull liquidation.
Correct.
Let's look at it. What do you have?
So this is the data which I was pointing out. A 54% jump in the open interest for IndusInd Bank. Look at the stock, what happened post that, 13% down. HDFC Bank, 79% jump in the open interest, 14% down. IDFC First Bank, just in the last 3 days, we saw 14% rise, subsequent 8% down for the stock. So this data itself as a club tells you that traders are not just exiting delivery-based positions, they are also looking to make money on the shorting side, which is an indication that you are looking at a prolonged downtrend for these stocks, not just a 3 or 5 day downtrend.
Why is ICICI Bank data different?
Yeah, so ICICI Bank is different. The stock, in fact, from 990 has actually jumped to 1030, and you saw short covering into the stock. And that's why post results, you've not seen ICICI Bank falling down, but it's actually rising.
So for next 1 month, is going short on the bank Nifty a good idea?
Yeah, I think going short on the private sector banking names, specifically Nikunj, could be a very good trade.
Isn't this a late trade now? Because for 3 years, if the stocks have given no return, the change could be around the corner.
But you know, Nikunj, the data is intriguing. They are not playing out for a 3% or 5% move on the downside. They are looking for at least a 2 to 3 month of a prolonged downtrend. Now, how much can the stocks fall? That could, of course, depend on the overall market construct. But it should not be mitigated towards just 3 or 5% downtick for these.
So your view is not only sell your delivery in private banks, also go short.
Yes, look to get fresh shorts.
What will challenge your idea? What will prompt you to change it?
The only change which we require when we tend to change our view is the significant change in stance from open interest.
Okay.
Because the stocks would move up higher if buyers come all out and then they say that they've changed their view from being bearish towards being bullish. Just as an example, what happened with ITC? 220 to 40 was a major hub of selling. Once that changed, you saw the texture of the stock changing completely. And 220 to 40, the stock was stuck for at least 6 months to 1 year.
Mantesh, Kunal has given the technical setup that for banks, large beholders of these stocks are now panicking or they're tired and they're selling the stocks. Looking at the case what we made, deposits are down, CASA is down. Is there case for banks now to underperform?
No, I don't think so. I think the problem with the bank is now they are readjusting to the new reality. You're right that the CASA ratio is down. Even the NIM, I think the major problem with most of the banks is from a sequential basis, the NIMs have fallen by about 10, 11 bips. So the basic issue with the banking business is that when your NIMs get compressed, you need to have a volume growth. NIM is like the margin, and the advances growth is like the volume. The volume of these banks are not growing as sufficiently as it was before because the deposit growth is pretty much muted. Now, it's a chicken and egg story. If you want higher deposit growth, you need to offer higher deposit rates, which would mean further compression of NIMs. I think this readjustment is what is really happening with most of the banks right now. Probably it is a 3 month, 6 month kind of phenomenon. And once we are through with that, the banks will be in a better position to not only grow their advances, but have better NIMs as we move ahead.
Mantesh, it's difficult to go negative on a sector which in a sense is a clear proxy on economy. But anecdotal data, if I look at it, car sales, unsecured loans and slowdown in some categories of retail credit, could we be at the early sign of some concerns in the second half for the banks? Because markets thought that come Jan 2024, FIs will come, credit growth will pick up and NPAs will never come back.
So I think, even within the retail book of the bank, I think what is plaguing them, you rightly mentioned about things such as the personal loan category growing very large. But for me, the more important figure is that the mortgages or the home loan side business is actually kind of growing quite weak. But within that also, if you look at across banks, you find different rates of growth. Axis Bank, for example, home loan portfolio has grown just about 10%, whereas on the ICICI Bank side, if I look at it, their home loan business has grown about 15 odd percent. Some of the POC banks have done even better. So this tells me that this entire readjustment that they are doing in terms of the rates that they're going to charge in the market is creating this disruption. Home loan growth is still strong for the industry as a whole. It's just that some of the banks are growing faster, some of the banks are growing slower. Once we see through that two-quarter kind of phenomenon, most of the banks will return back to that high growth number, readjust themselves to the market share kind of thing. And since you mentioned economy, the proxy, banks being the economy proxy, within that economy, it is the home loan segment which is actually really this proxy, because that's an indicator, large indicator of the consumption ahead. Once one is secure, once one individual is secure with a home loan, the consumption growth naturally starts picking up. So I'm looking at at a phenomena that says once we start recovering on the home loan growth side, we should see most of the banks through. And India being a very strong economy, that proxy linkage will still continue to remain strong.
All right, Mantesh, appreciate your time. Thank you so very much for joining us. Let's take a break. But here's an excerpt of my conversation with the legendary banker, Mr. KV Kamath, on why he feels that 10% GDP growth for India is actually around the corner. 10% for ladies and gentlemen. He's talking about not nominal GDP, but absolute GDP. Guess why? Because he thinks tourism will be the surprise factor.
I won't name any bank, but the order could change based on their ability to use technology and the heart they have to use technology.
But a 5 could become 2 or a 2 could become 1. But do you see that the top 5 banks in India, a new bank could become an entrant?
I would think that it is very difficult for a new bank to come in there because there's a whole lot of base foundation built up. And if I look at it anywhere in the world, the last 2 turns were tiger economies and before that Japan. The incumbent banks became stronger and stronger. So the top 5 banks certainly will remain strong. There will be a good base of other banks. But the base that the top 5 banks have built is very difficult to replicate.
With us, let's start our query segment, and I'm just going to use my phone for reference here to get the first query on Zee Entertainment. This is one stock where I guess we're getting a lot of queries. Batin Saab is also ready. We'll connect with him. 2,500 shares of Zee. Harivansh Rajput. Thank you, Mr. Rajput, for your query. 2,500 shares of Zee. The price target is at from Zee from August 2020. Should I add, hold, or sell? Now, my sense is that Zee, you may argue and say that in the near term, worst of the event risk is behind us. To make a case that Zee actually after today's move has bottomed out, it really would be too early. I think in my book, Zee now is in this wait and watch mode, where the next course of action would be a function of how the institutional investors who own more than 50% stake in Zee, they decide to really take a call on their investment. Then could there be liabilities and legal troubles because this is a merger which was on the table and suddenly 2 parties have walked off. So I guess in my book, I guess Zee would be something which you should be holding and watching rather than preempting anything else. The worst looks like in terms of prices behind us, but I don't think we are in for some V-shaped recovery. So Basin Saab, the worst looks like is behind us. Should one hold on now to Z? Because jo bhi hona tha ho gaya.
Yeah, good afternoon. Yes, Nikunj, you've summed it up correctly. But remember, institutions, that's LIC, mutual funds now own 63% of stake in that, including FIs. And they are not just passive investors. So there will be a lot of acrimony and court cases. But you can't get this company at a market cap of less than 20,000 crore. I think that there will be some solution. And like I said, there will be a little bit of wranglings. The business underlying remains robust, but like you said, it is a time-bound process till we get more news, and every day the news will keep changing. That is the character of the uncohesive thing which has happened because of this fallout with Sony. I still think there's a lot of value in this stock, but I would tell him to just stay put. And if you want to be in a media stock, then maybe Sun TV is giving us a very good opportunity in this correction. But for the time being, Z is a hold.
Babu from Trivandrum, I've got 1,000 shares of IDFC, buy, sell or hold. Now, but since the numbers of IDFC Bank, which would be the future entity which would house both IDFC and IDFC Bank, the numbers were not that impressive. Can one really ignore what we saw or what we heard from the management yesterday?
Well, you'll have to take it with the glass half full, half empty. There is a management which is very, very preemptive and which gives you the full, picture. But on the other hand, you know that the merger will create a huge behemoth which will have the AIF, the mutual fund and the holding company. I think the value unlocking over a period of time as the MSME book reduces will be very, very sharp. So I think it's a hold over here. If you want to add, this is a good price to do a SIP. But I think IDFC First over the next 3 to 6 months as deposits increase and the market gets better on the economy could head towards 3 figures.
Really appreciate your time. Thank you viewers for sending us your queries. We will try and accommodate as many queries as possible. But that's it on this edition of Tracking Trends. It was all about banks today. Hopefully in next couple of days we will get a clarity on to where the banking sector is moving. But as of now, a lot of bullish estimates for the banking sector have been shaped down. Stay tuned. You're watching ET Now. Last 1 hour of trade is something what we'll capture right after this break.